When you've lived 8 decades inside the markets, you stop believing in theories and start trusting scars. I've seen every kind of genius come and go. The ones with formulas, models, and fancy credentials. But do you know who survives? The ones who stay humble enough to admit what they don't know and disciplined enough to protect what they do. People love to talk about diversification as if it's some sacred commandment handed down from the gods of finance. They say, "Don't put all your eggs in one basket." But Mark Twain had the better version. Put all your eggs in one basket and watch that basket. That's wisdom. Because real safety doesn't come from spreading yourself thin. It comes from knowing exactly what you hold, why you hold it, and having the patience to let time do its work. When I was young, we didn't have computer models or professors who'd never owned a share of stock telling us what risk-adjusted return meant. We had common sense. And common sense says this: if you don't know what you're doing, then yes, diversify. Buy the index. Own the whole market. Accept mediocrity. But if you truly understand what you're doing, why would you water down your best ideas with your worst ones? That's not prudence. That's fear in a suit. Most people diversify not to build wealth, but to protect their ego. If one stock fails, they can shrug and say, "Well, it was only 5% of my portfolio." That's not investing. That's career insurance. And Wall Street is full of professionals selling that same illusion of safety to clients who crave comfort more than clarity. Diversification protects you from looking stupid, not from being stupid. It's a shield for the insecure, and this entire industry is built by insecure people selling that shield to even more insecure people. Real risk isn't volatility. Real risk is permanent loss. A temporary drop in price is not danger. It's opportunity, unless you never understood what you owned in the first place. The ignorant investor panics when prices fall. The owner smiles, because he knows value doesn't vanish just because the crowd lost its nerve. People forget that investing, at its core, is the study of human behavior, not math. You don't get rich by knowing every ratio. You get rich by understanding what people will always want and who can serve that need better than anyone else. When Warren bought Apple, everyone said he'd lost his mind. He doesn't do tech, they said, but he wasn't buying technology. He was buying human nature, habit, loyalty, desire. He saw not a gadget, but a cash machine powered by emotion. That's not speculation. That's understanding. You see, focus isn't recklessness. It's logic. If you have 3 ideas you understand deeply, why bury them under 30 you barely grasp? Because most investors can't handle exposure. Focus forces you to think. It takes away excuses. It exposes your intelligence and your stupidity in the same light. But that's the point. Accountability builds judgment. Judgment builds wealth. You can't hide behind 100 tickers and call it wisdom. That's not prudence. That's paralysis. In my 70 years of talking to investors, the biggest myth I've heard is that more holdings mean more safety. That's nonsense. Owning 50 businesses you don't understand isn't safety. It's chaos disguised as strategy. I'd rather own 3 great companies I can explain in my sleep than 50 I can't pronounce. Because safety doesn't come from numbers. It comes from knowledge. A deep understanding of one business is worth more than shallow familiarity with 50. Wealth isn't built in the markets. It's built in temperament. You can't control the economy, but you can control your emotions. The calm investor always beats the clever one because time rewards patience, not panic. The world doesn't pay you for activity. It pays you for accuracy. The market doesn't reward noise. It rewards clarity. Every great fortune you've ever read about was built the same way: focus, conviction, and endurance. Rockefeller didn't diversify into railroads and farms when oil worked. Ford didn't dabble in textiles when cars took off. Sam Walton didn't hedge his brilliance with mediocrity. They found one great idea, bet their life on it, and refused to let go. That's not gambling. That's rationality. There's a line I've said for decades: you don't have to be brilliant to get rich. You just have to stop being careless. Every crash I've witnessed, from 1973 to 2008, came from the same disease: people acting like traders when they should have been owners. They forgot what they bought, why they bought it, and what it was worth. When chaos hit, they sold their ignorance at a discount. The owner doesn't do that. The owner looks at panic and sees patience being mispriced. True freedom in finance and in life comes when you no longer need the crowd's approval to feel safe. You can't follow the herd and lead your own life at the same time. Independence is the price of clarity. The crowd seeks applause. The owner seeks peace. The speculator plays a game. The owner builds a life. And only one of them sleeps well at night. Now, let me add something most never teach in classrooms. Liquidity buys patience. Cash isn't an idle asset. It's oxygen for conviction. Without it, you'll suffocate under the pressure of volatility. The second thing, always invert. Instead of asking how to get rich, ask how to avoid going broke. Make a list of everything that guarantees failure: high fees, bad leverage, emotional trading, tax churn, noisy friends, and eliminate those before you chase brilliance. Avoiding stupidity beats seeking genius every time. If you remember nothing else from me, remember this: money follows clarity, not confusion. The idea that safety comes from owning everything is the definition of mediocrity. Own fewer things, understand them better, and hold them longer. Don't diversify your ignorance. Concentrate your understanding. That's not just an investing principle, that's a life principle. Because life, like investing, isn't about having a little bit of everything. It's about finding what matters most and holding on to it with both hands.